Assalamualaikum to Madam Fariha. Now, we are going to present our case study on Mr. D.I.Y Berhad. I want to introduce my team member. My name is Nurul Aida binti Roslan and my group member Muhammad Faris Hafizi bin Muhammad Raihan, Nur Fitrisha binti Muzamil and also Hana Batrisha binti Zainal. I want to explain the company background. Mr. D.I.Y Group Berhad is one of the most successful retail companies in the Southeast Asia, particularly in the home improvement and household essential sector. The company started as single store in 2005 and has since expanded rapidly to more than 1,500 stores across the multiple countries. Following its listing on the main market of Bursa Malaysia, Mr. D.I.Y has further strengthened its position as the market leader in Malaysia while continuing its aggressive regional expansion strategy. The company business model is built around a clear vision, which is to provide a wide range of daily necessity and home improvement products at consistently affordable prices. This is well known on always low prices strategy. Unlike the old hardware store that mainly focus on to contractor or supermarket, where home product are only supplementary item. Meanwhile, Mr. D.I.Y has created a unique market identified by making home improvement product accessible for everyday consumer. From an operational perspective, Mr. D.I.Y functions as an integrated retail company with a strong emphasis on efficiency and also standardized. Most of its outlets follow a similar medium-sized store layout, which simplifies inventory management and also ensure the consistent customer experience. It also supported by a increased supply chain and cost control mechanism. This standardized model allows Mr. D.I.Y to expand increasingly while maintaining the low prices. Overall, Mr. D.I.Y's competitive strength lie based not only in its extensive product range and also affordability, but it also in its efficient operational structure, which support long-term and sustainable growth.
Next, I will explain the liquidity position of Mr. D.I.Y by analyzing three liquidity ratio, namely the current ratio, quick ratio, and a cash ratio for the years 2023 and 2024. Firstly, current ratio. The formula of a current ratio is a current asset divided by a current liabilities. As you can see there, the current ratio increased from 2.23 in 2023 to 2.38 in 2024. This means that for every RM1 ringgit for a current liabilities, Mr. D.I.Y had a 2.23 ringgit of a current asset in the 2023, which improved to 2.38 in the 2024. This increase indicates stronger short-term financial strength. A current ratio above 2.0 generally reflects good liquidity, suggesting that the company can meet its short-term obligation without financial strain. So, the improvement was mainly due to higher current asset and a slight reduction in a current liabilities in 2024. Consistent with a Mr. D.I.Y, strong cash flow generation and a disciplined working capital management. However, the high ratio also indicates that a significant portion of a current asset is tied up in inventories, which is common in the retail industry. Secondly, quick ratio. The formula of a quick ratio is a current asset minus to inventory and divided by a current liabilities. As you can see, the quick ratio improved from 0.54 in 2023 to 0.68 in 2024, and it's showing that Mr. D.I.Y made a progress in meeting short-term liabilities using its most liquidity asset excluding the inventories. Although the ratio remain below 1.0, this is typical for retail companies where inventory from a large portion of a current asset. The improvement in a 2024 reflect better management of a receivable and a cash balance supported by a strong operating cash flow and efficient supply chain management. Cash ratio. And the formula of a cash ratio is a cash divided by current liabilities. As shown they are increased from 0.36 in 2023 to 0.43 in 2024, indicating an improvement in the company's immediate liquidity position. In 2024, Mr. DIY had a RM0.43 in a cash and cash equivalent for every RM1 ringgit of a current liabilities, compared to RM0.36 ringgit in the year of 2023. Although the cash ratio is below 1.0, it is a major concern due to the company's strong cash generating operation, high transaction volume, and its fast inventory turnover. The increase reflects improved cash management while still supporting the business expansion. To conclude, Mr. DIY liquidity position improved from 2023 to 2024 across all three liquidity ratio. The company demonstrates strong short-term solvency supported by hard current ratio and improving quick and cash ratio. Although the business remained inventory intensive, this is consistent with its retail business model and its efficiency managed through efficient inventory turnover and strong operating cash flow. Overall, Mr. DIY is a financially healthy and capable of meeting its short-term obligation without significant liquidity risk.
Next, we will calculate profitability ratio, which have gross profit margin, net profit margin, return on assets, and return on equity. So the first one is gross profit margin, which the formula is gross profit divided by sales and times by 100. So in 2023, we have 1,977,160 divided by 4,359,289 and times by 100, and you will get 45.36%. In 2024, we have 2,132,646 and divide by 4,651,416 and times by 100, and you will get 45.85%. So the gross profit margin measures the percentage of sales remaining after covering production costs. In 2023, the GPM for Mr. DIY was 45.36%, and in 2024, it slightly increased to 45.85%. This means that for every 1 ringgit of sales, the company keeps about 45 sen as gross profit, which can cover operating expenses, taxes, interest, and profit. And the slight increase suggests improved efficiency or slightly higher pricing, indicating stable and modestly growing gross profitability. So next is net profit margin, with the formula is earning after tax divided by sales. So and times by 100. So in 2023, after the calculation, we get 30%, and in 2024, we get 12%. So in 2023, the company recorded a net profit margin of 13%, indicating that it generated 30 sen of net profit for every 1 ringgit of sales. So this reflects relatively strong profitability and effective cost management during the year. In 2024, the net profit margin slightly decreased to 12%. Although both sales and net profit increased in absolute terms, the lower margin suggests that expenses grew at a faster rate than sales, leading to reduced profitability efficiency. So overall, the slight decline in net profit margin indicates marginally weaker cost control or higher operating costs in 2024, even though the company's overall performance remains stable and profitable. So the third one in profitability ratio is return on assets. So the formula is net income divided by total asset and times by 100. So in 2023, after the calculation, we get 15.79%, and in 2024, we get 14.96%. So return on asset measures how efficiently a company uses its assets to generate profit. So in 2023, ROA was 15.79%, and in 2024, it slightly decreased to 14.96%. So this means that for every 1 ringgit of assets, the company generated about 15 sen in profit in 2024. The small decline indicates that while net income grew slightly, total assets grew faster, leading to a minor drop in asset efficiency. The last one is return on equity. The formula is net income divided by shareholder equity and times by 100. So in 2023, we will get 32.13% and in 2024, we get 29.36%. So return on equity measures how effectively a company generates profit from its shareholders' equity. So in 2023, return on equity was 32.13% and in 2024 it decreases to 29.36%. This means that for every 1 ringgit of equity in 2024, the company generated about 29 cents in profit. The decline indicates that while net income increased slightly, shareholder equity grew faster, resulting in a lower return on equity. So the interpretation for profitability ratio is in 2023, Mr. D.I.Y recorded a gross profit margin of 45.36%, indicating that it retained about 45 cents from every 1 ringgit of sales after covering production costs. In 2024, the gross profit margin slightly increased to 45.85%, reflecting marginally improved cost efficiency and stable profitability at the gross level. So the company return on asset was 15.79% in 2023, showing that Mr. D.I.Y generated approximately 16 cents of profit for every 1 ringgit of assets. In 2024, ROA decreased slightly to 14.96%, indicates that the asset growth outpaced net income growth and slightly reduced the efficiency of asset utilization. So return on equity was 32.13% in 2023, meaning the company generated about 32 cents of profit for every 1 ringgit of shareholders' equity. So in 2024, ROE fell to 29.36%, suggesting a modest decline in how effectively equity was used to generate profit, even though net income increased slightly. So the net profit margin was 13% in 2023, indicating 13 cents of net profit for every 1 ringgit of sales. So in 2024, it slightly decreased to 12%, showing that although sales and net profit increased in absolute terms, expenses grew at faster rate than sales, resulting in marginally weaker profitability efficiency. So overall, Mr. D.I.Y's profitability ratios indicate stable and relatively strong performance, with slight improvement in gross profit management, but minor declines in asset and equity efficiency, as well as net profit margin, suggesting higher operating costs or lower cost control in 2024.
Next, I will explain the efficiency performance of Mr. D.I.Y by analyzing 4 efficiency ratio, which are inventory turnover, receivable turnover ratio, fixed asset turnover, and total asset turnover of the years 2023 and 2024. So, firstly, it's inventory turnover ratio. The formula of inventory turnover ratio is a cost of goods sold divided by inventory. So as we can see, it increased from 2,163.98 times in 2023 to 2,293.02 times in 2024. This shows that Mr. D.I.Y become more efficient in managing and selling its inventory during the year. The company was able to convert inventory into sale more frequently, which is particularly important for a high volume, low margin retail business like Mr. D.I.Y. This improvement indicates strong customer demand, effective merchandising strategy, and efficient supply chain management. It also suggests lower inventory, holding costs, and reduced risk of absolute stock, which align with the company's focus on operational efficiency and data-driven inventory planning. Turnover ratio. The formula of a receivable turnover ratio is a sale divided by a account receivable. As a result, we can see it decrease slightly from 98.34 times in 2023 to 95.04 times in 2024. Although there was a minor decline, a ratio remained extremely high, indicating that Mr. DIY continues to collect its receivable very efficiently. This is consistent with the company retail business model, which relies mainly on cash and immediate payment sales rather than long credit period. The increase in a trade receivable in 2024 is likely due to higher sales volume and limited credit arrangement with corporate customers, rather than a weakness in a credit management. Overall, the company maintains strong credit control and minimal exposure to bad debt risk, supporting stable cash flow. Now, the fixed asset turnover ratio. The formula of fixed asset turnover ratio is a sale divided by fixed asset. Now it showed that it remains stable, where increasing marginally from 5.27 times in 2023 to 5.28 times in 2024. This indicates that Mr. DIY continues to utilize its fixed asset efficiently to generate revenue. Despite the increase in fixed asset due to the new store opening and infrastructure investment, the company was able to generate proportionately higher sales. This reflects effective capital expenditure planning and efficient utilization of a physical assets such as retail store, warehouse, and the logistic facilities. The stable ratio suggests that these investments are contributing positively to revenue generation rather than resulting idle or underutilized asset. Total asset turnover ratio. The formula of total asset turnover ratio is divided by total asset, and now we can see it declines slightly from 2.15 times in 2023 to 2.0 times in 2024. This means that although sale increased in 2024, total asset grew at a faster rate due to expansion activity and increased investment in both fixed and current asset. The slight decline does not indicate operational efficiency, but instead it reflects Mr. DIY growth-oriented strategy, where assets are accumulated in anticipation of higher future revenue. Over time, these investments are expected to enhance operation capacity and improve sale performance. In conclusion, the efficiency ratio shows by Mr. DIY demonstrates strong and effective operational performance during the period under preview. Improvement in inventory turnover, consistently high receivable turnover, and stable fixed asset efficient indicate sound management and effective use of resource. Although total asset turnover declines slightly, it is reasonable within the context of business expansion. Overall, Mr. DIY has a successful balanced growth with operational efficiency supporting sustainable long-term business performance.
Next, we will calculate leverage ratio, which have a debt ratio, debt to equity ratio, and time interest earn ratio. In debt ratio, the formula is total debt divided by total assets and times by 100. So, after we calculate, in 2023, we get 0.51 or 51%, and in 2024, we get 0.4949 or 49%, and the debt ratio measures the proportion of a company's asset financed by debt. So in 2023, the ratio was 0.51, meaning 51% of the company's asset were funded by debt. So in 2024, the ratio decreased slightly to 0.49, indicating that 49% of assets were financed by debt. So this decline suggests a modest reduction in financial leverage, meaning the company is relying slightly less on debt to fund its assets and may have improved its financial stability. Next, we move to debt to equity ratio, which the formula is total debt divided by total equity. After the calculation, in 2023, we get 1.03 times, and in 2024, we get 0.96 times. The debt to equity ratio measures how much a company debt has for every 1 ringgit of equity. In 2023, the ratio was 1.03 times, meaning the company has slightly more debt than equity. In 2024, the ratio decreased to 0.96 times, indicating that debt is now slightly less than equity. This decline suggests that the company reduced its reliance on debt, strengthening its financial stability. So the last one for leverage ratio is time interest earn ratio, which the formula is earning before tax divided by interest expense. So in 2023, after the calculation, we get 10.96 times, and in 2024, we get 9.69 times. And the time interest ratio measures a company's ability to cover its interest expenses with earnings before interest and taxes. So in 2023, the ratio was 10.69 times, meaning the company could pay its interest expense about 10.0 times over. So in 2024, the ratio decreased to 9.69 times, indicating a slightly lower ability to cover interest, though the company still comfortably meets its interest obligations. So interpretation for leverage ratio is in 2023, Mr. D.I.Y reported a debt ratio of 0.51, indicating that 51% of the company's total assets were financed through debt. So this figure fell slightly to 0.49 in 2024, showing a reduction of 0.02. The decline suggests that the company relies slightly less on the debt to finance its assets, improving its overall financial stability. So the debt to equity ratio was 1.03 times in 2023, meaning the company had slightly more debt than equity. So in 2024, this ratio decreased to 0.96 times, reflecting a modest shift toward equity financing. So this change indicates a more conservative capital structure and lower financial risk, as the company can now carry slightly more equity than debt. So the time interest earn ratio stood at 10.69 times in 2023, showing that the company could cover its interest expenses more than 10 times over with its operating earnings. But in 2024, the ratio was decreased to 9.69 times, indicating a slight reduction in interest coverage, but still a strong ability to meet debt obligations comfortably. Overall, Mr. D.I.Y's leverage ratio suggests that the company has slightly reduced its reliance on debt, while maintaining strong capacity to service its obligation. This reflects prudent financial management and a stable capital structure, supporting long-term growth while minimizing financial risk. Next, we will calculate earnings per share, which the formula is profit after tax divided by number of ordinary shares. So in 2023, we get 5.94 sen, and in 2024, we get 6.02 sen. In 2023, Mr. D.I.Y reported an earnings per share of 5.94 sen, indicating that the company generated 0.594 sen of profit for each ordinary share. In 2024, EPS increased slightly to 6.02 sen, reflecting a modest improvement in profitability per share. So this growth shows that the company was able to generate higher return for its shareholders, even with only a slight increase in net income and a stable number of shares outstanding. So overall, the rising EPS suggests consistent earnings performance and shareholder value creation.
Next, I will explain about the financial performance of Mr. D.I.Y Group Berhad. Overall, Mr. D.I.Y shows a strong and consistent financial performance despite of operating in a challenging retail environment. Firstly, the company recorded strong revenue growth with the increasing revenue in around Rm 4.7 billion. This growth is driven by the continuous expansion of its store network and a high volume of customer transactions across Malaysia and Brunei. Secondly, Mr. D.I.Y profitability continues to improve. The company achieved a higher profit after tax of approximately RM 568.9 million, which reflects effective cost management and operational efficiency, even though the company maintains its always low prices strategy. Thirdly, Mr. D.I.Y operates efficiently, supported by the strong EBITDA growth, good inventory turnover, and economic of scale. These factors allow the company to convert sales into profit more effectively. And lastly, Mr. D.I.Y demonstrates sustainable expansion with more than 1,400 stores nationwide. This expansion is supported by strong cash flows and a solid financial position, indicating that the company's ability to grow steadily while maintaining long-term financial stability. As the conclusion, the financial analysis of Mr. D.I.Y Group Berhad shows that the company is financially strong, well-managed, and positioned for sustainable long-term growth. Based on the financial ratios analyzed, Mr. D.I.Y demonstrates a healthy liquidity position, allowing the company to meet its short-term obligations effectively despite being inventory intensive. Its profitability ratios indicate stable earnings performance supported by efficient cost management and a strong value-based retail strategy. In addition, the efficiency ratios reflect Mr. D.I.Y's ability to utilize its assets and inventory effectively to generate high sales volume, while the leverage ratios show a controlled level of debt, reducing financial risk during expansion. Overall, Mr. D.I.Y's strong financial performance, efficient operations, and disciplined financial management prove that the company is capable of sustaining growth while maintaining financial stability. Therefore, Mr. D.I.Y remains a competitive and resilient player in the Malaysian retail industry. That's all. Thank you.